The economic relationship between the UK and France is a complex tapestry woven from centuries of trade, travel, and shared history. It's a connection worth billions, shaping industries, jobs, and headlines on both sides of the channel. This guided walk explores the deals, the frictions, and the quiet dependencies that bind these two nations, delving into the concrete choices that will shape this relationship over the coming decade. We'll focus on four interconnected areas: energy, finance, regulation, and the everyday human decisions that translate policy into practice. These are the arenas where strategy meets reality, where ministers, investors, engineers, and small business owners all pull on the same rope. For centuries, Britain and France have been both rivals and partners, enemies and close collaborators. This rich history has forged deep economic channels, shipping routes, legal frameworks, investment patterns, and cultural habits that persist through generations. Ports like Dover and Calais became vital arteries of commerce, while London and Paris built financial bridges that have outlasted monarchs and governments. These enduring connections, passed down through families, firms, and institutions, adapt rather than disappear, anchoring modern trade in behaviors that policy alone cannot instantly change. The trade between Britain and France is extensive, encompassing everything from planes and car parts to medicines, fashion, wine, and cheese. While goods flow across the channel, services are equally crucial. Banking, insurance, legal services, and creative industries form the backbone of this relationship. The UK imports French cars, pharmaceutical products, and aerospace components, while exporting specialized services, luxury goods, and high-end manufacturing. Services remain a significant part of the equation. Multinational decisions on where to base research, list shares, or settle disputes have far-reaching impacts on jobs, tax revenues, and daily spending in both countries. Investment, though often less visible than trade, frequently has a greater impact. French firms own British assets in energy, retail, and banking, while British pension funds and corporations hold stakes in French infrastructure and industry. This cross-investment fosters mutual interests in market stability. When a French utility owns British infrastructure, both governments prefer predictable regulation. This shared ownership offers some insulation from short-term politics, but also introduces fragility. Political shifts, regulatory changes, or sudden policy divergence can quickly make strategic investments risky, prompting boards to reconsider plans and capital to pause. Energy is both the most technical and the most visceral aspect of the relationship. Technical because it relies on grids, contracts, and engineering. Visceral because energy bills and blackouts affect every household. France's significant reliance on nuclear energy gives it a different energy mix compared to Britain's rapidly expanding offshore wind sector. This difference is an opportunity, not a weakness. Interconnectors already transport electricity across the channel, smoothing out peaks and troughs. More could be developed. Additional cables, demand-side response agreements, and cross-border capacity markets would allow both countries to leverage each other's strengths in real time. Joint investment in hydrogen corridors, battery storage projects, and coordinated planning for offshore infrastructure would reduce duplication and lower unit costs. Crucially, energy cooperation requires contractual clarity. Long-term power purchase agreements, shared grid codes, and pre-agreed contingency clauses for maintenance and emergency supply will reduce commercial risk and make projects financeable. Regulatory alignment on grid access, state support rules, and environmental assessments will accelerate delivery and minimize disputes. Behind every gigawatt is a financing model. Aligning these models for predictability makes it easier for pension funds and institutions on both sides to commit capital. Capital seeks certainty. London remains one of the deepest global capital markets, while Paris has expanded its offerings. The sensible approach for both economies is not zero-sum rivalry, but structural complementarity. London can continue to be the preferred venue for global issuances and derivatives, while Paris strengthens niche markets such as sustainable finance, specific equity segments, and debt for infrastructure where EU access is crucial. Cross-listing and dual corporate listings are pragmatic solutions that allow French firms to access London liquidity while maintaining European investor access. Coordinated tax and disclosure standards for green bonds and sustainability-linked instruments will attract international capital to pooled UK-France projects. For banks and asset managers, while passporting may be politically sensitive, practical equivalence agreements and fast-track recognition regimes for specific market activities can maintain market access without full harmonization. Data rules will be a significant point of friction. Financial services depend on data flows for risk models, compliance, and client servicing. Clear, reciprocal data treatment, especially for transaction reporting and anti-money laundering checks, will prevent costly rerouting and duplication. Regulators investing in a permanent Anglo-French supervisory dialogue, with joint stress tests for cross-border exposures, will strengthen confidence during shocks and limit the need for disruptive emergency measures. Transport is the lifeblood of trade. Ferries, the Channel Tunnel, airports, and freight routes move goods and people daily. While post-Brexit checks introduced additional paperwork and occasional delays, logistics firms adapted by establishing new routes, different hubs, and improved scheduling to reduce friction. Airports like Heathrow and Paris's Charles de Gaulle remain global gateways, solidifying Britain's connection to European and international markets. The Channel Tunnel is not just an engineering marvel, but an economic lifeline. Disruptions there quickly ripple through supply chains, causing factories to pause, supermarkets to manage shortages, and holiday plans to collapse. The everyday reliability of these routes underpins supply chains vital to communities. People are a fundamental part of this relationship. Thousands commute, work, and study across the channel. Health services, construction, hospitality, and education sectors draw staff from both countries. While immigration rules alter patterns, they do not erase human ties. Families, friendships, and professional networks continue to move talent where it is needed. Migration is not merely a political headline, it is a practical mechanism businesses rely on. When a care home or hospital needs trained staff, cross-channel professionals offer a real and immediate solution. Talent shortages in one country create opportunities in the other, and these personal decisions, to accept a job, study abroad, or settle, are the practical building blocks of the economy. Tourism and cultural exchange soften the relationship and stimulate local economies. Millions of British tourists visit France, and French visitors spend across the UK. Hotels, restaurants, museums, and local shops depend on this movement. Cultural exports, films, music, fashion, also travel within this invisible market. While these flows may not be major line items in GDP headlines, they sustain thousands of small businesses and countless livelihoods. Shared tastes and cultural familiarity also facilitate more challenging political conversations, creating a baseline of goodwill that helps business deals proceed with less friction. Policy and finance are important, but the relationship thrives on small decisions. A buyer in Southampton choosing a French supplier, a head teacher in Lille accepting a British exchange teacher, a hospital manager recruiting from across the channel. Each decision contributes to the economic glue. Facilitating these choices requires addressing practical frictions, credential recognition, faster visa routes for essential skills, streamlined customs for small parcels,
and clear VAT guidance for micro businesses.
Local chambers of commerce, universities, and sector bodies play a crucial role here. Simple interventions, an online portal for cross-channel procurement standards, shared apprenticeship accreditation, joint local-level trade missions will reduce costs for micro and small enterprises. The economic multiplier of making it easier for small firms to trade is substantial because they are numerically dominant and deeply rooted in local communities. Several risks could disrupt this delicate balance. Regulatory divergence, where the UK and France enact vastly different rules for data, financial services, or product standards, would impose extra costs and complexity on businesses. Political friction, sanctions, Diplomatic rows or protectionist policies can spook markets and lead to trade rerouting. Supply chain shocks, such as energy crises, port closures, or major financial upheavals, can quickly ripple between the two economies. Geopolitical shifts necessitate careful choices about alliances and trade corridors. These risks are not abstract. Businesses already plan for them and adjust their strategies accordingly. There are also clear opportunities for deeper cooperation. Green technology and infrastructure projects offer mutual gains, from joint offshore wind developments to coordinated grid links. Shared regulatory frameworks, particularly in fintech and tech standards, could lower operating costs for companies in both countries and simplify cross-border business. Cross-channel education and research partnerships foster innovation and skill flows that benefit both labor markets. If policymakers and business leaders prioritize practical collaboration over symbolic disputes, the economic upside could be substantial, leading to higher productivity, more secure supply chains, and broader investment opportunities. Realistic scenarios must be considered. In a cooperative scenario, targeted regulatory alignment, joint green projects, and streamlined capital access would lead to stronger investment flows, lower long-term energy costs, and a more resilient supply chain. In a fractured scenario, politicized regulatory divergence, ad hoc trade barriers, and uncertainty in energy contracts would push firms to reroute supply chains, increase costs, and slow investment. Trade-offs are inevitable. Faster delivery of strategic projects may require temporary state support. Deeper financial cooperation may necessitate concessions on oversight. The pragmatic approach is to identify high-value sectors for immediate alignment: energy interconnectors, green finance, and digital data for financial markets, while allowing slower convergence elsewhere. A focused roadmap can accelerate the cooperative scenario. Firstly, establish an Anglo-French energy task force to approve interconnector builds, coordinate emergency protocols, and align permitting timetables. Secondly, negotiate a targeted financial services equivalence package for green finance and infrastructure issuance, coupled with a supervisory dialogue. Thirdly, implement a mutual recognition pilot for small business compliance in areas such as VAT, customs paperwork, and professional credentials. Fourthly, fund local-level partnerships between universities and training centers to ensure talent flows for health, construction, and technology. Each step is implementable within years, not decades, and each has measurable metrics: gigawatts of interconnector capacity, volumes of cross-listed issuance, time saved on cross-border customs clearance, and numbers of mutual recognitions granted. Watch for specific signals: new interconnector contracts, joint green bond frameworks, a French-UK supervisory memorandum on banking, and pilots that ease small business trade. These actions are more significant than rhetoric because they alter incentives for investors and firms. The relationship will evolve through pragmatic increments, project by project, rule by rule, and decision by decision. This comprehensive view maps the actionable pathways that transform strategic intent into economic reality. Energy contracts, finance agreements, and regulatory pilots are not abstract lines on a page. They are the scaffolding that determines whether the UK and France can leverage their long history into a competitive advantage for both countries. Practical cooperation leads to lower costs, more secure supply, and better jobs. The balancing act can shift from fragile to durable if policymakers, businesses, and everyday people make the same pragmatic, incremental choices that have sustained this relationship for generations.